China's economy just posted its weakest quarterly growth since 2022, and it came in below the government's own target. So what went wrong, and why does it matter far beyond China's borders? Let's start with what happened. China released its second quarter GDP figures, and the number disappointed. Growth came in below Beijing's full-year target range of 4.5% to 5%, a range that, it's worth noting, is already the least ambitious the country has set in decades. The culprit, according to the data, is a slump in investment, and the miss has immediately fanned calls for more stimulus from Beijing. That's the headline. Now let's unpack why any of this matters. To understand why this is significant, you need a bit of context about how China sets its growth targets and what they actually signal. Unlike most major economies, China announces an official GDP growth target at the start of each year. It's a political as much as an economic statement. Missing it, or even approaching the lower bound, sends a message to markets, to trading partners, and to China's own policymakers that something needs to change. The fact that Beijing had already set the range at 4.5% to 5%, described widely as the least ambitious target in decades, tells you that expectations were already being managed downward. So when growth comes in below even that, it's a double signal. The economy underperformed relative to a bar that had already been lowered. That combination is what's driving the stimulus conversation. China's leadership has a strong historical preference for hitting its stated targets. Missing them publicly, especially in a year when confidence in the domestic economy is already fragile, creates pressure to act. Investment, the component that slumped, is a particularly sensitive category here because it's one of the main levers the government has traditionally pulled to keep growth on track. Infrastructure spending, property development, industrial capacity, these are all forms of fixed investment, and when they weaken together, it's a sign that neither private businesses nor state-backed entities are deploying capital at the pace the economy needs. Here's where the mechanics get interesting. China's growth model has, for a long time, leaned heavily on three engines: investment, exports, and consumption. Each of these tells a different story about where money is flowing in the economy. Investment, think factories, infrastructure, real estate, creates jobs and demand in the short run, and productive capacity in the long run. Exports tap into global demand. Consumption reflects the confidence and spending power of ordinary households. When investment slumps, as the data for this quarter shows, it tends to create a feedback loop. Fewer projects mean less demand for raw materials, less work for contractors, fewer paychecks flowing through supply chains, which in turn weighs on consumption. And China's property sector, which has been under significant stress for several years now, sits right at the heart of the investment picture. Real estate has historically accounted for a very large share of household wealth in China and of local government revenue. When the sector weakens, it pulls down both. The calls for stimulus that followed this data release are grounded in a well-worn playbook. China has used fiscal and monetary tools repeatedly over the past 15 years to stabilize growth. Infrastructure investment binges, cuts to banks' reserve requirements, reductions in lending rates, targeted support for specific sectors. The question policymakers face now is whether to reach for those tools again, how aggressively, and whether doing so addresses the underlying structural issues or simply defers them. There's a meaningful debate among economists about whether stimulus that props up investment in an already overbuilt economy is good medicine or just a short-term fix. That debate is very much alive right now. So what does a slowdown of this kind actually mean for China and for the rest of us? Inside China, the most immediate effect is on employment and income. growth below target means less economic activity than planned, which tends to show up in hiring decisions, wage growth, and consumer confidence. A population that feels uncertain about its financial future tends to save more and spend less, which is precisely the dynamic that Chinese policymakers have been trying to break for years, as they attempt to rebalance the economy away from investment and toward domestic consumption. The irony is that an investment slump, if it's not offset by stronger consumption, can actually deepen the very problem the rebalancing effort is trying to solve. Outside China, the ripple effects depend heavily on what happens next. China is the world's largest importer of many commodities: iron ore, copper, soybeans, energy. When Chinese investment slows, demand for those inputs typically softens, which feeds through to commodity exporting economies from Australia to Brazil to parts of Africa. Chinese consumer spending, if it weakens, affects global brands across luxury goods, automobiles, and technology. And if Beijing responds to the slowdown with a major stimulus package, that sends its own set of signals, potentially lifting commodity demand, but also raising questions about debt sustainability and long-term structural reform. For global investors, a China growth miss of this kind tends to introduce uncertainty into forecasts for corporate earnings, supply chains, and emerging market economies that are deeply tied to Chinese demand. None of those effects are inevitable, and how large they turn out to be depends on the policy response that follows. But the uncertainty itself is a real variable that markets have to price. So how should we classify what we're looking at here? This is a cyclical growth disappointment sitting on top of a structural transition. And those two things are pulling in different directions at the same time. The cyclical part is the investment slump and the GDP miss. Those are the kinds of problems that stimulus can address, at least in the near term. Inject money into the system, get projects moving, stabilize employment, and growth numbers can recover. China has done this before and done it effectively. But underneath that cyclical story is a structural one. China is trying to shift its economy from one that grows by building things to one that grows by people buying and using things. That transition is hard in any economy, and it takes time. Property sector stress, local government debt, demographic pressures, and weak consumer confidence are all part of that longer structural picture. They don't respond to a simple rate cut or an infrastructure package. For investors and businesses watching this space, the key question isn't just what the second quarter number says. It's what Beijing decides to do next, and whether that decision addresses the surface problem, the deeper one, or both. China's economy is too large and too interconnected to treat as a sideshow. When the world's second-largest economy posts its weakest quarterly growth since 2022 and misses its own modest target, it's a data point that belongs in every serious investor's thinking. If you found this breakdown useful, subscribe to Investors Club Global for clear, no-hype analysis of the financial news that shapes your portfolio. Hit the like button if this helped you understand the story. It genuinely helps others find the channel. And drop a comment below. Do you think Beijing will reach for stimulus or try to hold the line? We read every reply.